Hey, I'm back with Blayney White, Cross Country Mortgage, to talk about lenders and the world that they live in.
Welcome to the Live Explore podcast. If you like what you hear, please hit like and subscribe.
Welcome back, Blayney.
Thank you, Alan.
Okay, let's get into it. What's happening in the mortgage world?
Oh, it's painful. It's been painful.
Tell me about it.
Well, originations are down, obviously. There's no refinances unless you're needing to do a debt consolidation, which at this point, some people are needing to do debt consolidations. We can talk about that. But the cost of originating loans for mortgage banks and bankers is up year over year, and there's a lot of lenders moving out of the lending space that are traditionally banks that hopped into lending over COVID, and they've backed off. So we can talk about that too.
Okay, so that means less lenders is what you're saying? Less options for a buyer,
Yes.
right? I don't have all these options I used to have. Now I have a smaller pool to go after.
That's right.
Okay. Now, are you seeing movement back from people who are like maybe a Bank of America are going into mortgage brokering?
Oh, geez. I hope a banker isn't going to brokering because they're going to get slaughtered trying to figure that out. However, a mortgage banker, if an originator works for a mortgage bank that doesn't broker, they might find themselves in the position of needing to go back to brokering.
What's the upside? What's the downside for a mortgage broker versus somebody working for a company that has maybe a specific set of tools?
Oh, well, great question. So a broker has very little control over turn times and underwriting queues and the file itself. So it's hard to make commitments to realtors if you're brokering a file and a realtor wants a 15-day close of escrow, forget about it. Not on a broker file. Now, the advantage to a mortgage banker is we do the file ourselves, we underwrite fully up front, we approve, we send out docs in our name, we fund in our name, and typically we service up to about the first 6 payments before it goes to a servicer.
Oh, no, go ahead.
So at Cross Country, we have mortgage banking is our primary function, but we have all of the brokering options as well. So if there are originators out there right now that are stuck at a mortgage banking house that don't have brokering options, call me because I'll hire you.
So let's define that because you can get confusing, right? What's a mortgage banker versus a mortgage broker versus maybe an originator, I guess is the term for like
At a bank.
At a bank, great.
Okay, let's start with a bank.
Okay.
A bank is like any big box bank you see on the corner. They only have the products they have, and they're really out there looking for clients to deposit their money at the bank. So that's the name of the game right now in the marketplace. They're after your money. They want you to move your money from bank A to bank B, and then they'll give you a loan that is slightly more advantageous. But again, they only have super conservative loans that are inside the box because at the end of the day, all originators are selling the loans on Wall Street in securitized mortgage pools.
Okay.
Okay, so a mortgage banker is going to we do the loan up front, we originate, approve, underwrite, send out docs, fund, and service about the first 6 payments in our name on our line of credit, and then it is sold in a securitized pool on Wall Street afterwards. A broker is an individual who is a loan originator that sends a loan to a bank or a mortgage bank, but they're not employed by that company. They have no control over the file, and they are at the mercy of whatever the turn times are for that bank. I'll give you a good example of that. Back in the day, Union Bank of California was a big broker shop. meaning that there were a whole bunch of loan originators out in the marketplace that would compete for business and then send it to Union Bank. Union Bank would do all the work. They would underwrite, approve, fund, make sure everything was compliant, and then they would service that loan. Off goes the mortgage broker, who gets paid their one-time commission based on sending a loan to that bank.
Okay.
Okay?
All right. So what advantages for each one of those? Because, all three should have some advantage somehow, even if it's just a little bit, right?
Sure.
Okay, like an originator, right?
Okay.
Besides they're going to get my money, which is not an advantage to me.
No, it isn't.
Right?
Or your financial planner.
Correct.
Or your investment advisor.
So, and I got to fit in the box. Mm-hmm. But if I do all that, give them my money, fit in the box, is there a rate benefit? Is there a okay?
Yeah.
Is there a cost of loan benefit?
Sometimes. I mean, every bank is different. But yeah, there's usually some perk for you giving them your money because they're going to make money off your money. So it's kind of a wolf in sheep's clothing. It's not a new business strategy. Was a very prevalent boutique bank here in the Bay Area that was gobbled up recently this year. And that was their whole business strategy. Deposit your money, and we're going to turn around and lend it to borrower B over there at a premium, but we'll give you a small discount for depositing your money so we can turn around and lend it. The bigger banks are doing that, less so to that extreme extent, but that's their business model.
Okay.
One of them, anyway. So there is an advantage on rate. There can be an advantage to fee. It depends on, I suppose, whatever programs or promotions they're running and how many of their services you're buying as a consumer when you enter that bank.
Okay, so that's like a lot of other cost, right? You're giving up your money, right? You may not be getting the rate of return there that you might have gotten someplace else in exchange for a discounted rate.
Yep. It never pencils out, by the way. I hope every consumer is listening to me. It never pencils out to move your money from position with an investment advisor or another bank to a bigger bank just for a lower interest rate. I'll show you time and time again. It doesn't work out.
Okay, so a mortgage banker, where is their sweet spot in terms of this is the advantage they have?
We have speed. We're nimble. We do all the work up front, so that all you have to do is get an appraisal and a prelim once you enter into contract. So you can win in the marketplace against someone who has to go with a longer turn time, either brokering or at a bank, because the banks don't underwrite up front.
Okay, so that sounds like you're underwriting the potential buyer up front.
Yep.
Okay, so pre-approval, pre-qualification, and fully underwritten.
Yes.
Okay. Explain those three, because pre-approval and pre-qualified, I think, get confused all the time.
Can you, before I explain them all, can you explain to our listeners why you're asking that question? Where is it on the contract?
Okay, it is on the loan off to the right. It asks you if it's pre-approved, is it pre-qualified, or fully underwritten.
Yep.
And fully underwritten is a far better position to be up front. Okay, so it's really just, if you explain all three,
sure,
for people who maybe don't understand it, it would help.
Sure.
Okay, so
on the purchase contract, on the car form, there is in item 6B, your agent has to check when they present a pre-approval or a pre-qual or fully underwritten with the offer. They have to check on that contract which of the three you've decided to do when you're placing the offer. A pre-qual just means, hey, I called a lender and I gave them 2 pay stubs and I told them what I have in the bank and they did a soft pull on my credit. That's a pre-qual.
Okay.
A pre-approval is I submitted all of my income documentation, all of my asset documentation, and we ran credit. And based on the guidelines, it looks like I qualify.
Okay. And then
Okay.
fully underwritten means,
Fully underwritten: income, assets, employment, funds for down payment, funds for reserves, anything funky on the credit, anything historically that needs to be unearthed now, all of that's done up front. Because the reality is 90% of the failure rate of a loan happens on those items. That's why you, as a real estate agent, are required to tell the seller and the listing agent which level of detail the borrower has gone into in terms of obtaining a loan.
okay.
Yeah.
So you said as a mortgage banker, once you do the loan, you service it for about 6 payments.
Yeah, depending on the loan size, the loan product,
Okay.
when we're ready to bundle it with other loans.
Okay. Then it goes to a servicer.
Yep.
Okay. So if the servicer goes out of business, can I stop making my payment?
Oh, no, no, no. Well, I mean, anybody could stop making their payments, but you'd probably ruin your financial life for a very long time and lose your home, most likely. So it's never advisable to stop making payments, even if a servicer goes out of business or, for instance, a big bank, that boutique bank we were talking about, they went out of business. They were acquired by another institution. So that transition is happening right now from the boutique name to the big box bank name. But you're still making your payments right now to the boutique name until that transition and acquisition have taken place. So the answer is never stop making your mortgage payments. You always make them until you receive in writing a change for a new location.
Okay. Isn't there some confusion about that? I mean, even if it's not a servicer going out of business, somebody sells it, the loans get sold.
All the time.
Oh my God. Every 6 months you end up with a new servicer. You got to change all your banking information for that loan, right? So in that transition, you're still paying the previous servicer, right? And that money doesn't get lost in the transition?
No, they are required to hold those funds and then they transfer them over to the new servicer. So they'll keep recording up to whatever that cutoff date is.
Okay.
And then any payments that are made after that cutoff date, there's a window of time that they're required and they will transfer that payment to the new servicer. But you, as the borrower, the onus is on you to make sure your payments are going to the right place.
Okay.
Okay?
So on the mortgage broker side, okay, you talked about you don't really control the file. You typically, maybe it's not an always thing, right?
No, I mean
Timelines.
Timelines, you have zero control. You can beg the account executive over at, say, what used to be Union Bank. You could have begged, and they would say, I can't promise you, but I'll do my best. So get me this, and this.
Okay. So a mortgage broker can't fully underwrite?
No.
Okay.
They pre-qual or pre-approve.
Okay. That doesn't sound like a lot of fun.
No, it's not. And if you think about it, in this market, even today, a great house that's priced well, there's a lot of offers going in on it. I just read a factoid that a great house that's fairly priced is getting on average 3 to 5 offers now. Again, so if a house is getting 3 to 5 offers and you want to stand out, but you don't necessarily want to pay top dollar, it's in your best interest to go ahead and get fully underwritten.
Right.
Because you're going to have an advantage, quicker close, guarantee to the seller that you will close.
Okay. So what do you think product-wise? This is a little different because I don't have a somebody says, where do I see the market going? Right. Well, where? What market? What area? And every area has niche areas in it, right? So are there certain products you see coming down the line, potentially coming down the line, that are going to be maybe not new, maybe they're just old products that are now relevant, or they're going to try and bring them forward, right? Do you see anything like that happening?
Absolutely. So every day we get notifications of new QM. It's called QM and non-QM. QM stands for qualified mortgage. So typically things that meet guidelines under 43%, they're A paper loans, they're perfect loans, they're going to fit into the QM box. Non-QM means that there's something that is not part of those guidelines. Non-QM, good example of QM versus non-QM would be debt to income ratio.
Okay.
It's a big one. So 43% is QM and 45% would be non-QM. But all other attributes to the loan are the same. So that lending space is available and there are more investors or more products in that space now because the majority of the Fannie Mae, Freddie Mac loans that are current homeowners, they're already there. They're in their homes. They've got the Velvet Noose 3% mortgage, and they're going to stay in that home. The first-time home buyers, they may fit into QM, but there's a lot of buyers out in the marketplace today that are non-QM, meaning there's something non-conforming to the guidelines. And those products are growing. The offering for them.
Okay, so but that is it consumer debt is why you find people above the 43?
Well, gosh, that's an interesting question. It may be because the property doesn't fit QM, right? So it may be like a non-warrantable condo. What's a non-warrantable condo? It means that when the questionnaire is filled out by the homeowners association, there's something checked on that questionnaire that Fannie Mae won't insure that loan then. That's a non-QM loan then. It has to go non-warrantable. That's an example of a property. It might be something where the reserves are not being met on that loan. So that would make it non-QM. The most common one is debt to income, though, where they're 44% up to 50%. Another one, non-QM, would be, hey, I can't show you as a self-employed borrower 30 days of pay stubs and W-2s, but I can show you 12 or 24 months of deposits from my business, and we can average that as income to qualify you. So if you're a self-employed person and you've got alternative documentation to show your income, that would be a non-QM loan. Doesn't mean it's not a great loan. It doesn't mean you're not making the money and you can't afford to make the payments. It just means it doesn't fit those guidelines that Fannie Freddie would follow.
Okay, so what's the ratio for when you just consider what the loan is going to be in terms of like 43 was the debt to income ratio? What part of that is the loan?
Okay, so there's a housing expense and a total expense. So a housing expense is usually, we don't really want to see anything above 33%.
Okay.
And then 43. Now, 43 including all other expenses.
Okay.
Now, FHA, VA, they have different guidelines, but they also follow QM, but they have slightly different ratios, just out there in listener world. But what I'm seeing a lot of homeowners make a mistake doing right now is they're taking on other types of debt to preserve the low interest rate on their first mortgage. So they've got 2 or 3 credit cards, and those credit cards are on average 19 to 20% interest.
Right.
That's a problem. They may have taken on a car lease because cars were hard to get. So they took a lease because the expense of the car was higher than what they had budgeted instead of getting a loan. And that money factor is really high. So when you look at all of the other debts, maybe they have a home equity line, which they got last year, and this year it's over 10%. When you average all that interest and you average it over time, oftentimes it doesn't make sense to hold on to the lower mortgage rate because you're carrying so much other debt at these higher interest rates. If you were to just consolidate it and do a much lower interest rate somewhere in the 6s, then all of a sudden you're saving several $1,000s a month in a lot of cases by not trying to preserve the low interest rate on the first mortgage by carrying debt elsewhere. So that's a really important thing to think about as you accept that credit card offer or as you accept that home equity line of credit as a consumer. Make sure you know what you're doing and don't just go rack up that debt so that you're not having to refinance your first mortgage.
And is that what you were talking about, consolidating debt?
Yes.
Basically refinancing?
Yes.
Okay. How often are you seeing somebody are people doing that right now? I mean, because there are a lot of people out there, I think, have a 3% note,
Yeah, they
right?
do.
And it doesn't make a lot of sense. It doesn't appear to make a lot of sense to say I'm going to refinance, wipe out all this other debt, but now I'm going to be paying it, 6.25% or something like that.
True. But collectively, your overall interest rate is lower on all that debt when you do a debt consolidation in most cases right now. So the other thing I'm seeing, just to compound it even further, is that homeowners won't sell their house because they've got a 3% note, but they've racked up all this other debt. So not only do they have all this other debt, but they're in a house that doesn't suit them anymore,
Right.
and they refuse to sell it because it's a 3% note. So that's just like salt in the wound. And I really think that it would help people to let go of the emotional attachment of a number on the mortgage and do what makes sense for them fiscally every month so that they're not having to go out and get that credit card.
To continue paying.
Yeah.
Didn't you say earlier, maybe I misunderstood, that refinancing right now is almost non-existent?
True. Very few. People are very, very stubborn right now. I think it would help a lot of homeowners out there to reconsider and take a look at the overall financial situation they're seeing themselves in.
So you almost sound more like a money manager, right, than a lender per se.
Yeah.
Do you see that out there much? I mean, usually I talk to a lender and they want to talk about the loan for a house. They're not necessarily telling me, hey, look, they're not showing me this analysis that says, it's a higher interest rate, but you wipe all this out and your overall payment is much lower, even though it's all in your house.
And you could get a different house that suits you better if that situation has arisen now, since when you took that note. And yeah, it does sound more like an investment advisor or a financial person, but I tend to look at every borrower holistically. I look at the whole picture to make sure I understand what were their objectives versus what are they now, because we know one thing is true, everything changes. So the decisions they made before to get that note are not necessarily the right answers for today's needs.
Okay, I had a question that's sitting there. Payoffs. Okay,
Payoffs.
So somebody has money in the bank reserves. They have, one or two car loans, maybe a couple credit cards. And I'm not talking about their crazy numbers, but it doesn't really matter, right? So I want to buy a house, and I'm looking right now. You've, pre-approved me at this number, right? But part of that pre-approval says you got to pay off the cars
Yes.
or a car or something, right?
Right.
When is the best time, if I'm already looking, when's the best time to pay those off? In escrow, before I get into contract? When's the best time to pay those off?
I always say pay them off before you go shopping, because what always happens is that people go out into the marketplace and they decide that they're going to shop at $750, but then they go out and they see what they can afford at $750 and they want to go to $800. Well, if they've satisfied that debt, they may have the wiggle room to go to $800. There's always a rational point to money and an emotional point to money. The rational point, or the scientific point, is, okay, how much does this cost every month? And the emotional point is, hey, I really don't want to live in this neighborhood. I want to live here, and I want that extra bedroom. Whatever the emotional response is, maybe one of the rooms is painted pink and their daughter fell in love with it and that's what they want. You don't know. But if you prepare yourself by eliminating all the debt that you can before you go shopping, you'll have latitude to make changes in your thinking as you're looking at properties, because it inevitably happens.
So that also ties into your credit score, right?
Absolutely.
Okay, so if just use July 1 because it's here in a couple of days. All right, starting July 1, I want to go look. I've got 2 cars, 2 credit cards, and you say my credit score is X. if I pay off the credit cards, it goes to Y. How soon does it go to Y, roughly?
Well, there's a little trick with credit cards, and a lot of consumers don't know this, but you really should be paying your credit cards twice a month. Because if you do, then one of those payments will always get scooped up in the servicer's data, and they'll see that you're making on-time or early payments. That boosts your credit score by its nature. So you should always make 2 payments per month, one when it's due and one halfway through the month, whatever that window of time is. But it does take about 30 to 45 days for credit scores to really show, because what they look at in their algorithms is the total debt that you can get into versus the total debt that you have used as a consumer. So if you're paying twice a month, that number is impacted, the ratio between what's available and what you're using. It's kind of a little game, but it does help your scores.
So if I do, so, okay, the 2 scenario, right, the scenario, 2 cars, 2 credit cards, and I'll use the 750 and the 800,000. So right now with my credit score and my income and resources, I can go to 750. But you say I should, let's say it's just the 2 credit cards, okay, again, right? I should do that first, wait 30 days, have you requalify me.
No, you don't have to wait. If you just want it to show up organically as the servicer reports to the bureaus, pay twice a month. Your loan officer can do a supplemental credit report and show that you've paid it to 0, and hopefully that impacts your scores. It doesn't 100% of the time, but it can give you some lift to your credit scores. In other words, don't not shop because you're paying things off. Do them both simultaneously, but make sure you're paying the credit cards twice a month. And if you can pay them to 0, even better.
Okay.
As you're paying them off.
How long? So if I started doing that now, starting July, I'm going to make credit card payments twice a month. How many months goes by before it would show up to the servicer, where we'd start to see an effect?
30 days.
Oh, that's not bad. Okay. And if given the choice, right, 2 cars, 2 credit cards, which one has more weight with my credit score?
Credit cards.
Why?
Because they are considered unsecured debt, and a car loan is an installment loan secured by an asset.
And that's why you're here. That was good. Okay. Is there anything else in the lending world, right? I mean, everybody talks about what's going on in the market for real estate, right? And they talk about, you hear about jobs reports and inflation, but you don't really hear other than, somebody's not lending anymore. Is there anything else in the marketing world for lenders?
Yeah.
That is coming down, that's starting to happen?
First of all, to every consumer that's out there shopping, bravo, because sellers are more realistic right now than they were a year ago and 2 years ago in terms of what they're willing to accept for a price. So remember that as a consumer, it's always better to get the lower price on the home, because the home is forever and the tax basis it starts with is forever, but your interest rate on your mortgage is not. Remember that a mortgage is a tool to get your name on title. Okay? So if your mortgage is a tool to get your name on title and you're comfortable making those payments for 6 months, 12 months, cool. You've got a huge discount, or hopefully a discount, on the purchase price. We'll be refinancing your loan. It's guaranteed. If you own a home for 7 years, the average refinance happens at around 3 years. Most people will be refinancing within 36 months, guaranteed, from where we are today. And yet you're out there in the marketplace, you got a haircut on the price to begin with, a lower tax basis to begin with. The rates will catch up and improve. I don't know when, but it's guaranteed that they will.
What's the magic number on a rate change? So I think it's 0.5%, but you're gonna have to tell me. Like if your rate drops at least 0.5%, that's a good time to go refinance.
It can be, yeah. It also depends on the term of the mortgage you have currently. So if someone buys a home today and their interest rate is 6.9 on a 30-year fixed, and next year at this time they have the opportunity to get 5 7/8 or 5.875, jump on it.
Okay.
Now, if there's a whole bunch of fees with that to get that rate, then maybe it's not the right time. It depends. If your lender is offering you that rate, but they want you to pay 2 points for it, probably not the right time to do that refinance. But if they're offering you the 5.875 and there's no points on it, cool, take that loan.
Okay.
Yeah.
If the market is volatile on rates, meaning they're moving a lot, not necessarily going up a lot or down a lot, but there's a lot of movement in there. Is that a better time just to hold until it settles, or it gets to that half a point down or whatever that number is, right? All things being equal with fees, do you move 2 or 3 times? I mean, if it jumps around in the course of a year and a half.
Yeah, you want to refi after 6 payments. Typically, that's the rule of thumb. So don't call your lender back after you just got a refi and you've made 1 payment and you want to refi again. Don't do that, because that's actually, you have to show that you've made payments on that mortgage. So typically the lender wants you to do 6 payments. There's something called EPO, early payoffs. There are penalties for all lenders. Most lenders do not want to refi you within 6 months. And shame on the competitor out there who refis a borrower and they can see that they've only had it for 2 months, because that costs their competitor tens of thousands of dollars. So it's not cool to do that. Plus, as a consumer, you want to show the consistency and that you've actually made the payments. But typically 6 months is where you want to start looking again at refinancing.
Okay, here's the crystal ball question.
Here we go.
It's the same world that we live in here in real estate. What's going to happen to the market, right?
Yeah.
So what do you think is going to happen with the rates? They've talking about there's going to be another 1 or 2 increases, right? I mean, you and I talked in a previous podcast about you thought this is the time to pause, right? So what do you?
And they did pause. To my credit, they did pause. So
on the 2 rate increases, do you anticipate them like a half a point, a quarter point, or is that kind of nobody really knows?
I think we're probably going to get a half a point before the end of the year. I think at last the Fed is listening and actually waiting to see what all of the previous adjustments have done, because it's trailing data to see if it's working or not. So it's starting to come in, and some of the numbers are better. Let's see if they're going to be patient enough to wait for all the trailing data, but I do think they're going to at least give us 1 adjustment before the end of the year for a half a point.
Okay. Blayney, thanks a lot. That was great.
Thank you.
We got off on other topics that I actually think were very valuable for buyers who aren't well versed in what happens behind the scenes.
Yeah.